Hello. Welcome to another edition of A Matter of Interest by MoneyFarm. I'm Richard Flax.
And I'm Jack Amy. So today we're going to have a quick catch up on what's been going on in the stock market, focusing primarily on tech stocks. And then we're going to have a little look into UK politics after the announcement of Keir Starmer's resignation. Please remember that when investing, your capital is at risk. The views expressed here should not be taken as a recommendation, advice, or forecast. If you are unsure investing is the right choice for you, please seek financial advice. So, Richard, we've seen a bit of volatility that's maybe uncharacteristic relative to what we'd experienced so far in the year in the stock market, predominantly in tech stocks. There's not been too much in terms of changes in fundamentals, but can you give us a run through over what we've seen and what might have caused that?
Yeah, so there are a couple of points to make. Obviously, there's a huge amount of interest, and as you say, in terms of kind of fundamental or reporting, there are a couple of things that we can look at. There's Kerabras, which is a manufacturer, a semi-manufacturer that IPO'd in May, and they reported their first quarterly earnings, and the revenue line was very strong, but there was some perhaps slightly unexpected margin erosion. The gross margin was lower than perhaps people had expected, and that prompted a sell-off in the stock. The stock is trading as of today, which is June 29th, slightly below the IPO price, but it's quite volatile. It's moved around. So you can see that obviously the top line is pretty robust. Margin a bit disappointing, and for a first earnings report, perhaps short-term investors or traders might look at that and say, well, it's not a great signal that's so close to when you IPO'd, you've managed to disappoint investors, at least to some extent.
But it seemed they were maybe a victim of the wider kind of tech ecosystem there, where the margin erosion perhaps came from factors that were out of their control, or more operational factors like slower build out of their own data centers and things like that.
Yeah, and that's a fair point. I guess some of this is about what you might call IPO structure, right? Where you IPO, you make a set of promises to investors, and then right out of the gate, perhaps you don't quite hit those promises, and that's a fact of life, right? For businesses, particularly in a volatile and very fast growing environment. And the danger is that investors maybe read too much into a single earnings report, even though it's only the first one. The other notable earnings release was from Micron, and there it was pretty consistently good news, well ahead of what investors had expected or what investors had hoped for, and you got a pretty solid reaction to that. And I guess the key takeaways from my perspective are: look, the underlying market is still pretty robust. Demand is very strong. Companies are struggling in some cases to meet that demand. We saw Apple, for instance, raise prices across a number of its products because it said it was struggling to get DRAM or memory chips because demand was so strong. Micron indicated, I think, in their comments that they weren't sure when that supply-demand imbalance would move back into line, speaking to their perception of very strong fundamentals. So there, the underlying kind of environment is strong, but inevitably you're going to get volatility in terms of individual company performance, and that's something that I think we and investors need to live with as we try to understand how strong that demand is, whether it can be sustained, what sort of capital investment is going to be made ahead of that, and what return that capital investment will ultimately generate.
And I think it was interesting on Micron, I would say, that you saw very positive market reaction, I think more on the beat with guidance. And do you think maybe the market's in a place where perhaps earnings being just hit is maybe not quite enough to cause a rally in the name? Or do you need to be providing very, very strong signaling with the guidance for what's still to come?
Yeah, look, so it's very interesting, and it's interesting for a couple of reasons, right? Because the way that you pose the question is, and it's the way that we all sort of pose the question, but it's as we know, impossible to know what is priced into a stock, right? That's by definition. We say, well, what's priced? We can see what consensus earnings expectations are for a group of analysts who follow these stocks. But that's not the same thing. It might be pretty close, but it's not the same thing as saying this is what's priced into a stock. And so it's inherently unknowable. What we do know is that or what we perceive is that expectations are pretty high across the industry. And so it seems reasonable to conclude that to match those expectations, whatever they might be, you need to show very strong results and display kind of well-founded confidence that growth or that will continue. And I think it's we should be wary of committing too much in terms of saying yes, we can know this with certainty because obviously we rarely can.
And so yes, and there was, I would say, other factors that have gone on in the last couple of weeks that I think may be worth mentioning. So there were a couple of big rebalancing events. There was the inclusion of SpaceX in a couple of key indices, which is, I think, very, very newsworthy, but maybe more market moving was what was going on with the Russell indices. So to give a bit of a headline, FTSE Russell runs some indices. They track most of the US market between them, and they have about $11 trillion tracking them. So lots and lots of money. And I think one other factor that perhaps is causing some of the volatility that we've seen is those indices are or have, we're recording this on Monday, the 29th of June. But the indices rebalanced on the 26th of June. They had to swap some of the factors. And you saw some legacy software names, which maybe haven't done so well in the last couple of months, shifting into the growth index, and more of the AI semi or memory names shifting into the growth, semis into growth, software into values. But you have seen a lot of sort of more flows-based pressure on the market. And what I mean by that, less tracking the fundamentals, less tracking the story and the positive potential earnings of the stock, but more tracking the underlying market mechanics. And I think it's interesting that you've had quite a few very, very large events squeezed into the same couple of weeks, namely a couple of inclusions in terms of SpaceX into some fairly chunky indices, which obviously have lots of capital, either in ETFs or mutual funds tracking them. And then also some quarterly rebalancing that pension funds or other large investors might do. Do you think that moves the needle maybe more in the short term, or do you think there's an underlying fundamental story that maybe the market is getting wind of?
Look, I think it's it's a challenging question for a couple of reasons. I think in the short term, these flows can drive prices in a relatively short term. That's not our investable time horizon at MoneyFarm. We don't, we track it because we think it's interesting and relevant, and we're trying to see if there is any signal in all of that noise. But generally speaking, over a 1 week or a 2 week view, we broadly speaking think of it as noise in the context of our investment process and our investment time horizon. But I think we are always looking for those signals, and I think we need to be mindful of market structure. And what that can mean. And obviously, at the very headline level, a lot of that has, when we think about market structure, a lot of people think about passive investing, about ETFs, about flows kind of into index product. But there are other examples of that, right? And obviously, we've talked about Korea, for instance, and we should explore that a little bit. But obviously, a market that has performed very strongly for good fundamental reasons, given that it's the home of a lot of of the tech supply chain,
yes,
but also some idiosyncrasies and some regulatory changes that maybe the regulator thinks with hindsight were not the best idea.
Yes, so Korea had a bit of a perfect storm, as it were, last week, where you had on one day, I think it was the 23rd of June, you had two circuit breakers where the stock exchange decides that the price of the index has moved so far that it's going to halt trading for a period of time to allow investors to, in essence, calm down. But yes, the regulator had come out and said they had approved previously leveraged ETFs on single name stocks. So again, ETF being an exchange traded fund, we predominantly use those rather in their more conventional form of index tracking products. But you can get some more esoteric ETFs which do things like leveraged exposure to a single name. Now, Korea's got a very interesting makeup where, number one, it had this wonderful run up this year in terms of the performance of the overall index, and there were couple of reasons for that. As you say, the top two largest companies are roughly 50% of the index, but both sit at that very crucial bottom of the semiconductor supply chain. So that's Samsung and SK Hynix. However, if you've got a lot of leverage exposure to them and they respond to some kind of a drop in sentiment in the market, that can cascade very, very quickly. And I think the regulator had both set up the market for a rally by doing this sort of new name and shame regime where they were punishing companies that were trading at below booked price. So companies that, if you looked at all of the balance assets, etc., on the balance sheet, the stock price, if you looked at all of the assets that the company owned, the stock price was lower than that. And the regulator had kind of put in some policies and some incentives not to do that. And it had caused this big run up, particularly in these two stocks, which also had kind of been very part of the AI run up. And then the sort of unwind of those leverage products which the regulator had also approved did cause quite a lot of volatility in Korea. And we saw two particularly torrid days, one of which where it's 10% down.
Yeah, and so the interesting question there is how much we should read into that. What's clear to us is that there is volatility in Korea, and so to the extent that you have that exposure, we should be mindful about how you size it. Leveraged ETFs on single names is not something that we would invest in our discretionary portfolios. But we should also be mindful of the fact that the underlying fundamentals on a range of names in Korea has been pretty strong. But I think in general it does speak to this this ongoing kind of challenge for us is from an analytical perspective of how much to think about fundamentals, how much to think about market structure, how much to think about flows, which is some of the stuff that we think about and worry about on a relatively short-term basis. Our starting view obviously would be that over the long term, fundamentals win out, strong profit growth, strong earnings growth, starting valuation all matters. But over a shorter time period, which 3 months, 6 months, a year, that some of that volatility, some of that market structure and things like that can play more of a role.
And it's, I think, also useful to say that we can look into this just to discount it in terms of, is this changing our fundamental view? Can we explain away the volatility and maintain a more constructive view on, for example, tech or semiconductors, whilst accepting that there are factors that over the short term might cause volatility that we don't think is predictive of what we'll see over the 12-month plus horizon that you're speaking about?
I think that's right. And I think, you could reasonably ask, well, guys, this is not part of your investment process. Why even think about it? And for me, at least, on the one hand, it's a fair point and we shouldn't kind of be influenced by it particularly too much. But we are constantly looking for signal in what is inevitably in any given kind of market environment, an awful lot of noise. And so, as you say, a lot of stuff we can dismiss and say we think it's just noise, but sometimes we need to be mindful of the fact that sometimes it might be a signal, and that's what we're on the lookout for. Before we continue, a quick note about MoneyFarm. We're a digital wealth manager with a simple purpose: to combine passion, expertise, and technology to give clients the 3 building blocks of investment success: access, advice, and low cost. Today, we help people manage their wealth through investment portfolios, pensions, ISAs, cash savings, and self-directed investing, all accessible through our platform and app. Whether you prefer to make your own investment decisions or receive expert guidance, our services are designed to support you at every stage of your financial journey. Alongside our team of investment experts, clients can also access Bastion, our AI-powered agent, which provides personalized insights and clear, accessible guidance to help them make more confident financial decisions. As always, remember that investing involves risk. The value of investments can fall as well as rise, and you may get back less than you invest. The views expressed in this podcast should not be taken as advice. Now, back to the conversation.
Okay, well, that's really, really interesting. And yeah, let's see if the fundamentals or the flows play out in tech stocks over the coming 2 weeks and further on. Now, switching focus, we have seen UK Prime Minister Keir Starmer resign. We had to check the dates on whether it was 9 or 10 leaders that the UK had in the last 10 years, but there's been a bit of volatility in the leadership of the UK too. And it's looking and shaping up that Andy Burnham will run to be the next Prime Minister, possibly without any challenges. Do you think that changes our outlook on the UK economy or UK assets much, if any?
Yeah, so Andy Burnham looks likely to be the next head of the Labour Party, and kind of by extension at this point as the next Prime Minister. And so the question is, what will he do? He's due to make some general policy statements virtually as we're recording this, and people will rightly push him on what those policy statements. He's talked about things like devolution, what those really mean, kind of going forward. He's talked in the past about they've floated some ideas around increased taxation, they've increased spending, all a sort of a familiar refrain that we heard when the new government came in, and Keir Starmer as Prime Minister, Rachel Reeves as Chancellor. And so our starting thought is that, at least initially, we're not sure how much is really going to change. It will be, there will be an arc of policy, taxes potentially, which is relevant to us. We could capital gains taxes increase? Yes, potentially they could. Our starting thought, though, has been, generally speaking, that the tax regime in the UK is already, taxes as a percentage of GDP are already pretty high. Yes. The tax base is already fairly narrow, by which we mean that a relatively large percentage of households account for, or a relatively small percentage of households account for a relatively large percentage of income taxes generated. A lot's been said about welfare spending, about all of these things. And so it's also reasonable to say that if there was an easy lever to pull to accelerate growth, to accelerate revenue, to give government more fiscal firepower to work with, it would have happened, right? The solution here is a lot of hard yards, we think, around optimizing spending, trying to get people to work, trying to find out what levers the government can pull to encourage growth. But, I think that, and I don't think we will, but if we do see some sort of nice, neat solutions that, if you only do this, then it all will be well, I think we will all be a little bit skeptical of that, because I think, a lot of people have tried very hard to come up with solutions to these key questions about growth, about improving government services, and the solutions are not super straightforward. What does that mean? Well, Burnham has, for financial assets, which fundamentally is what we care about. Look, yields are relatively high. We haven't seen them move that much in recent weeks, I think, because there's an understanding, or that the likely kind of incoming Prime Minister has said he will kind of stick to fiscal rules. He'll potentially look to do things kind of on the margin. But a wholesale change in the approach seems unlikely, at least for now. And so I think that fixed income investors in particularly will be mindful, will be wary. But I think that starting yields reflect some of those concerns, and we would expect to see a sensible and relatively experienced cabinet be put together. That's a baseline view, right? Now we need to see what actually happens, and whether that changes our assumptions. And the other part is, to the extent, as you say, that we've seen a number of, prime ministers come and go over the last decade, it speaks to some level of dissatisfaction with politics and with policy. And I think there is a danger that 12 months down the road, if we're right, and if, actually, not that much has changed, and, that it's a long process, and Burnham has already given his sort of tenure, given the speech about it's going to take a decade.
Yes.
Rightly so, probably. That you get a kind of a new round of disappointment, either within the Labour Party or within the country at large. And so then you see, perhaps you see people move to kind of extreme is maybe not the right word, less orthodox approaches than we've seen up until this point. And obviously we've seen a fragmentation, or we are seeing a fragmentation in voting intentions today, at least. Let's see if it...
And across the political spectrum.
If it comes to fruition in a general election, which is still some years away. So there's all of these sort of possibilities. For bond investors today, we don't think there's a particularly significant risk. That's at least our baseline view, and so yields we think are look relatively fair. So where does this all leave us? We think that the kind of Overton window, the arc of policy will be in line with what we've seen, and that should reassure bond investors. We think, at least in the short term, we do think that I at least think that there's a danger that if you roll forward 12 months and you've got some variation of more of the same, because it's really difficult to move the needle, and it takes a lot of time, that the kind of the Labour Party and the public at large may be disappointed once again. And so, as we've seen the sort of fragmentation of UK politics in terms of voting intentions, at least, that that potentially voters go to less orthodox solutions or less orthodox kind of political figures than we've had up until this point. And so that represents a challenge in, I'd argue, 12, 18 months time, whenever whenever the kind of honeymoon period, such as it is, begins to fade. But for now, at least, we think that fixed income and gilt yield should be relatively well anchored.
Yes, and it's interesting that you say that, because I think both you and the market are saying the same thing, with the fact that yields didn't move very much on the news that Starmer had resigned, and with the probability that Burnham leads the Labour Party and therefore the country being fairly high. It suggests that the bond market is pricing in something similar to what we're seeing now, given the lack of change there. But I think, just to have one kind of recap, it's interesting that Starmer did resign, and I think it says something maybe more about the internal state of the Labour Party than perhaps the country. Because if you look at the underlying successes that Starmer's had, he maybe hasn't sold them very well, but kind of the economy is growing slowly, but it's growing. Inflation seems to be under control, and maybe Burnham will get a bit of a tailwind from the fact that it looks like the conflict in Iran is moving towards some form of a conclusion. So there maybe isn't the same kind of potential skew upside in oil prices. And there have been some homes built, net migration is down. So it doesn't seem like Keir Starmer's been that unsuccessful as a leader. And yet, as you say, the sort of the humdrum of disappointment and, I don't know, the lack of popularity even within his own party seems to have caused him to resign.
Yeah, and look, from a financial markets perspective, it's interesting for us generally, but we should, I guess we should be focused on the financial markets impacts of all of this. Look, from a financial markets perspective, you can look back to the very beginning, and the new party comes in, the government comes in and says it's all terrible. The other lot have left us with a real mess. And so you got this sort of quite negative drumbeat early on, which is perhaps not super helpful. It's difficult for anybody to come in and say everything's great, don't worry. But by the same token, that desire to sort of reset the narrative, possibly with hindsight, didn't do them a lot of favors. As you say, inflation is higher than you would like, but hopefully coming down. Growth is, positive, but still fairly low, and perhaps not where you need it to be to see,
yes,
from a fixed income perspective, debt to GDP materially come down. The eternal question of, how much can the government influence that over a 1 or 2 year view is very relevant, right? You say that, obviously there were a number of policies that they put forward that they then had to kind of walk back. And so there was a certain schizophrenia of disappointment between, you put forward a policy and then you walked it back, and I didn't like that policy in the first place. And so,
yes.
So you sort of, the danger is that Keir Starmer lost both ways. But look, at the end of the day, we still need to kind of be mindful from at least a perspective from a fixed income view, which is, how do you grow the economy faster? How do you increase prosperity so that you can improve the creditworthiness of the British state, and you can deliver the services that the public needs? Those are, at least in my mind, those are the same questions that Andy Burnham faces or will face are the ones that Keir Starmer and Rachel Reeves faced, and the answers are not. Well, they're not super straightforward. Obviously, otherwise it would have been. If it was easy, it would have been done already. And so I think that when you come back and you look at Keir Starmer's record, yes, certain things have happened. Were they as a result of the policies of the government? Perhaps less clear. Did you have a sense of kind of real progress moving forward on the things that you thought the government could control? Also, not super clear. So, we put a lot of kind of stock in who is the Chancellor, who is the Prime Minister, what are they going to do? And over time, yes, that can have an impact, but we should be mindful that the UK is, a relatively small open economy, and so is as likely to be impacted by, what happens to the price of oil, how fast does the global economy grow, and can the UK capture some part of that, as it is by anything that a government does on a 6 or 12-month view. And so we need to be mindful very much of the local policy and political context, but we also need to keep in mind the kind of the broader global macro perspective.
And potentially that it might not matter for a prospective investor buying a gilt relative to a treasury or a bund. So much the sort of the political idiosyncrasies that are going on, it may be the underlying economic fundamentals that you're speaking about that drive that more so than incremental policy change.
I think that's right. Look, I think if you did something that was really damaging, then that would have an impact. Yes. But if you are being kind of incremental about it, then it's perhaps less likely to have a significant impact. But will be super interesting to see. Obviously, as people living in the UK, we hope that the new Prime Minister is hugely successful in achieving this sort of improved growth, improved delivery of public services, all the things that voters and citizens would be looking for.
Absolutely.
Great. Well, that's all we've got time for today. Lots of stuff that we've opened that we'll continue to monitor in the coming weeks. But thank you very much for listening.